Hi all, thanks for joining us this evening and welcome to our webinar on property debt funds. First off, a little bit of housekeeping. For everyone's comfort, we have microphone, cameras, and the chat turned off. You can ask questions via the Q&A function. We will run through the presentation and then we'll have a Q&A at the end. We were aiming around 45 minutes of presentation and then 15 minutes of question and answer at the end. My name's Xander and I'm joined by Joe Christie today. He's the Executive Director of Capital Property Funds. So I'm just going to start off with a quick disclaimer. So our returns that we talk about today are not guaranteed. So if you put $250,000 in term deposit, that's guaranteed by the government. Our returns are not, and we can't give financial advice. So what are we going to cover today? So we're going to do an introduction into capital property funds. We're going to cover why borrowers pay a higher interest rate. So they could go to the bank and pay 7%. But why do they come to us and pay 10, 10.5, 11? So we're going to dive into that because that's a really important part. We're going to do what a risk-adjusted return is and dive into 4 important factors that CPF consider. The next is we're going to do an overview of 4 lending opportunities that we currently have. And then, as I said, we're going to have question and answer at the end. So the CPF Property Debt Fund at a glance. So the fund inception was in 2018. The fund originates and invests in loans secured by registered mortgages over Australian property. The fund's unlisted and we regard as a capital stable asset. So I'll just dive into 2 parts of that. So capital stable asset. So we're investing in Australian property, which is considered a relatively stable asset. And it's unlisted. So it's not trading every day like shares or bonds on exchanges. And finally, I'm going to look at our historical performance. So looking at our 1-year return of 10.67%, we're very proud of that. It's a very good return. And then when we look to 3 and 5 years, that's when the cash rate was 0.1% for majority of the time. And we still managed to return great returns to our investors. And then as interest rates have gone up from 0.1 to they peaked at 4.15%, we've been able to capture that return. So yeah, it's something that we're really happy with here. So I'm just going to start with why borrowers pay 10%. And Joe's going to talk about that as well. So Joe, could you walk us through why they pay 10%?
Yeah, look, thank you, Xander. Look, it's probably, we call it the elephant in the room question or item. We get asked a lot by people assume that we're lending to borrowers of last resort. And in actual fact, it's the opposite. So we find that experienced developers that have been through the financing cycle, excuse me, actually come to non-bank lenders like capital property funds because they can achieve higher sales revenue, which means higher profit, in a shorter time frame. And the best way to explain that is using the analogy of a person that has acquired a parcel of land that has approval to build 10 residential land lots. And we can break that person into 2 separate alternative universes. So person 1 goes to the bank and let's say they borrow $1 million to acquire the block of land, and they're going to, as I said, that parcel of land has approval to build 10 individual land lots. And let's pretend that those land lots could be worth around about $1 million each. So there's potentially $10 million in gross realisable value here, which obviously will translate into profit. Now, they go to the bank and they borrow the $1 million to buy the block of land, and they may be borrowing the money at, say, 6 or 7%, significantly lower than going to a non-bank lender. But they've then got holding costs. So the bank won't let them start constructing the individual land lots until such time as they sell down the 10 land lots, what we call a pre-sale. So the person in the alternative universe that's gone to the bank is sitting there having holding costs, trying to achieve sales. And it's just a cow's paddock. And it's quite hard to achieve those sales. So as the time goes by, it might be 3, 4, 5 or 6 months, they decide, look, I'm going to drop my sales price in order to achieve the pre-sale. So instead of selling them for $1 million per lot, they drop the sales price down to $900,000. So they've automatically lowered their gross realisable value from $10 million down to $9 million. And then once they've achieved those pre-sales, they can then start construction. And usually that takes sort of 9 to 12 months. So let's say that there's an 18-month turnaround for the person in the alternative universe that went to the bank. So it's taken 18 months and they've generated $9 million in revenue, and they've had that additional 6 months of holding costs. So while they had a cheaper rate from the bank, the total interest cost was getting quite close to what it would have been if they had just gone straight to a non-bank lender. So the person in the other alternative universe that goes to a non-bank lender like capital property funds, they acquire the block of land and they commence construction straight away. So from day one, they're already constructing, and the project is finished within, say, 9 to 10 months, and the finished product looks really good, and the market's moved a little bit as well. So instead of getting $1 million per block of land, they might get $1.1 million per block of land. So they're now grossing around about $11 million in gross realisable, versus the person who went to the bank it is grossing $9 million. And they've done that within a shorter time frame of 12 months. So put simply, they make higher sales revenue in a shorter time frame. And typically you find that it's the experienced and well-worn developer that knows what they're doing that typically have gone through that funding cycle with the banks, and they find themselves coming to non-bank lenders. So they're definitely not borrowers of last resort. They're typically experienced, high-quality developers that, as I said, they want to make more profit in a shorter time frame.
Thanks for that, Joe. And again, an important elephant in the room to get out of. And it's borrowers that the banks don't fully understand, and that's left a gap in the market for companies like CPF to provide lending and get these developers finish their projects quicker and earn more money. So the next thing we're going to go to is what is a risk-adjusted return?
Look, this is really important too. And effectively, it's a return that reflects the risk associated with an investment. So the more risk that's involved in an investment, prima facie, there should be a higher rate of return. And so there's nothing wrong with taking on risk, but you want to make sure that you understand how much risk is involved and that you're getting adequately compensated for it. And what Xander will be talking about in a moment is that he's going to talk about all the things we go through when we price our opportunities to our investors. We want to make sure that it represents a really good risk-adjusted return.
So there are four main things that CPF look at when we're pricing investor returns. The first one is quality of the counterparty. So firstly, is it someone we've lent money to before? We always think that we like repeat customers. And are they considered an expert in their field of development? So this could be land subdivision, this could be industrial, this could be commercial. So have they done it before, and are they considered very good at it? The next bit is, what is the LVR? So that's loan to valuation ratio. The third thing is, what is the position in the capital stack? So the capital stack we break down into three areas. So there's a first mortgage, a second mortgage, and then equity position. And you should get a return that reflects the risk associated with each spot in the capital stack. And then the final thing is, where are we in the development life cycle? So we break the development life cycle into three areas. We've got planning, construction, and marketing. So Joe, could you talk to us about the quality of the borrower?
Look, it's the key to the whole thing. What we want to be dealing with is really good quality counterparties or really good quality borrowers. So we believe that the most risk is when you're lending to somebody for the first time. So we're really looking for repeat customers. So we regard our borrowers as a partner. We want to have a long-term relationship with them. So it's really important to get the quality of the counterparty right. It's got to be a good fit emotionally, financially, etc. It's got to be a win-win for both parties. So we're looking for that long-term partner. What you also said before is that they need to have experience in the asset class. So, for example, I believe that we're dealing with some of the best, if not the best, developers or private developers in the east coast of Australia that are experts in their particular field of interest. So we have one counterparty or borrower who is an expert in land subdivisions. And if you look at those particular developers, they've got an in-house marketing team. They've been working together for a long period of time, in-house finance team, and an in-house project management team. So they're very good at finding potential land subdivision opportunities, executing upon that opportunity, and then selling it down on time, on budget, and for a profit. So it's really good. It's really important to have good quality counterparties. And look, what we have found in our experience is that when you see a low quality opportunity in a fringe location that doesn't look very good, typically that reflects the quality of the counterparty. They're a fringe operator. So we find that really good quality counterparties tend to source and acquire really good quality projects. And it just makes life easier for everybody.
100%. So the next thing I'm going to talk about is the LVR. So what is the LVR? It stands for loan to valuation ratio. So if I've got a block of land that's independently valued at $100 and we lend $65, that'll have an LVR of 65%. And what does that mean for debt providers? So it's basically the wiggle room we have. So the land has to fall from $100 to $65 before we lose any capital. So the wiggle room we have, and you can go up to a 75% LVR, but you can go to a 50%, and it's just adjusting the wiggle room. And a 75% LVR has more risk than a 50% LVR. And we think that if you've got a higher LVR, you deserve a higher return because that's a risk-adjusted return. You take on more risk, you should have a higher return. So that's what the LVR is. And it ties well into the next point, whereas what is the position in the capital stack? So we majority do first mortgages, and our first mortgages have this LVR of 65%. So you're first to get repaid, and it's a very safe and good place to be in the capital stack. When we move up the capital stack to a second mortgage, that's where we have an LVR around 75%. And again, you're moving up the capital stack, you're taking more risk, so you should get a higher reward. And then finally, at the top of the capital stack, we have equity, which is probably from 75 to 100% LVR. And you don't have much wiggle room there. So you're very, there's a high risk position, but again, you can have the greatest reward there. And then looking at how we price the capital stack. So as I said, first mortgages here, we do at 65% LVR, and our returns around 10 to 11%. Moving up to the second spot in the capital stack, the second mortgage, an LVR of 65 to 75%, and we think return should be around 16 to 18%. And then finally, for an equity position or the owners of the project, we think it should be around 27.5% per annum. But that depends. And with an equity position, you're only paid at the back end. So it could be a 3-year project and you might not have anything from day one till the finish. Whereas a first mortgage or a second mortgage for us, you're getting paid every quarter. So you're getting that income and you're in a much better spot in the capital stack.
Just to add to that too, is that we offer opportunities in every position in the capital stack. So first mortgage, second mortgage, and equity-like provisions. But as Xander said, the further you go up the capital stack, there's nothing wrong with sitting in any position in the capital stack, but clearly being aware that what position you're in and that you're getting adequately rewarded. So we have had some examples where investors have come in saying, I'm getting a 14% return, and they're in a junior or a second position within the capital stack and not getting an adequate risk-adjusted return.
So yeah, that's extremely important. Moving on to the development life cycle. So could you walk us through this, Joe?
Yes. So another thing we look at, which is really important, is planning risk, construction risk, and marketing risk. So we believe that there are 3 sectors to a property development. If I go to the first one, which is being planning risk, do they have the relevant planning approvals? And broadly speaking, capital property funds does not take on planning risk. And the best way to explain that is by way of example, where we had a borrower who had purchased a parcel of land in the Northern Rivers region of New South Wales, so a really nice location, and they were looking to do a residential land subdivision. However, when we looked at the planning approval, the parcel of land was still zoned rural, and it would take a very long time for them to get the relevant approvals to do a land subdivision. So that was something that we were not interested in funding. And we do have, by using an example, we have had investors that have invested into a particular property development opportunity that had significant planning risk, and they're still in that opportunity 3 or 4 years later, and nothing's happened because they can't get the planning approvals. So we always want to have what's called a development approval. So the site has got an approval for something to be built, being an industrial development, a commercial, or a residential, some sort of residential development. The planning risk we would take on might be waiting to get an operational works approval, but we certainly wouldn't take on any more planning risk than that. The other thing is construction risk. So the joke what we say internally is that make sure they're not building the Taj Mahal. So we like to do doable deals, and we always ask our in-house construction management team, if we had to, can they step in and finish the project? So we like to do land subdivisions. So that's what we call a non-built form construction. So not to say that they're simplistic, but it's primarily a parcel of land that's being divided up into smaller parcels of land. So it's pushing dirt around, putting in retaining walls, curbs and guttering, sewer, water and power. So you're not building something intricate like a home or an apartment block, etc. So it's non-built form construction. So that gets a bit of a green tick from us, is that you're a little bit lower down the construction risk spectrum. We like low-rise residential development, so that $5 to $20 million area, townhouses, architecturally designed apartment blocks. We probably wouldn't do a large Harry Triguboff style apartment high-rise. We like industrial because it's highly profitable. It's just typically what you call tilt slab construction. So it's precast concrete slabs that are just tilted up using a crane. And the profitability at the moment on industrial is highly lucrative. So you're building it around about $2,000 a square metre. And we're seeing some of our borrowers achieve rates of up to $6,000 per square metre, and commercial. And what I want to talk about here, so we really want to understand the construction risk. We meet the builder. Are they suitably qualified to build this particular project? We are a party to every single construction contract via what's called a tripartite deed, which means that if one of the party fails, such as if the borrower goes bankrupt, the builder can't decamp from site because, hey, we're still a party to this contract and we want to keep the contract going. So we want to keep you on site and we want to keep you committed to finishing the project. It gives us step-in rights. We can step in and complete the project if we want to. And also, if there's any variations or cost disputes, we are a party to that contract and we need to approve all of those. So there's some of the things we do around mitigating our construction risk, but it's really, really important to understand construction risk. Mm-hmm. And the last thing is marketing. So we sort of say it's very easy to lend money. The hard bit's getting paid back. It's quite easy to buy a parcel of land with all the approvals in place. The hard bit is to build it to program and to budget, and then to sell it down in an efficient manner and in a profitable manner. So some of the things you want to be looking at is what marketing program does the borrower have? Do they have their own in-house marketing team? Have they had experience in selling this style of product before? We like to look at comparable sales. So there'll be an example of a loan that we have going to talk about in a moment where this was stage 5. So you had stage 1, they'd built and sold down in an efficient manner. Stage 2, they built and sold down. Stage 3, they built and sold down. So stage 4. So by the time you get to stage 5, you can see the comparable sales. So it gives you really good confidence around the saleability of this product. Another thing we look at is pre-sales. We're not hard and fast on pre-sales, but we've got one in Paddington, which we'll talk about, where they've pre-sold. They have an approval to build 12 high-end residential apartments. They've pre-sold 3 of them. That gives you some comfort around the saleability of the product. And finally, coming back to some of the points that Xander mentioned, is you also look at your loan to valuation ratio cushion, which is your worst case scenario. So if you've got finished product and it's worth $1 million per block of land, for example, and the borrower just cannot achieve any sales, your worst case scenario would be, well, I've got a loan to valuation ratio of 65%. If push comes to shove, we can reduce the price from $1 million down to $650,000 and everybody still gets their capital back. But as I said, we've never, ever had to do that. That's your worst case scenario. But they're all the things you really need to be aware of, is that the further you are through that development life cycle, the less risk there is. And so if you're in the planning stage, that's probably when there's the most risk. Then in the construction stage, the risk is reduced. And once you're through the construction stage, you're just in the marketing stage, and so the risk is reduced. And we do have some really good opportunities in the marketplace at the moment that are what we call latter stage construction projects, where they've got all the planning approvals. They've now midway through or 3/4 of the way through their construction program. They're built to program, they're built to budget. And then what you find is once activity happens on site, sales activity gets stimulated, and you can find that they've also achieved a fair amount of sales, which will give you debt coverage. And what we mean by that is if the debt is $10 million and they've achieved $12 million in sales, they've got more than 100% debt coverage. And there's some opportunities we have in the marketplace at the moment that are providing excellent risk-adjusted returns, all in around that 10 to 11% returns.
I think an important point you raised there about marketing was comparable sales or pre-sales. So anything that verifies the independent valuation on the project does give us a lot of it reduces the risk significantly.
Yeah, it's a big green tick.
Yeah, exactly, because we know that the product can be sold at a particular price, and that again, if we don't have comfort around that valuation, then our LVR is off, because the LVR could be, we could think it's a 65% LVR, but if the value of the land's not that high, the LVR might be much higher, and it's a much riskier situation. So definitely pre-sales and comparable sales are a big tick
very
here.
important.
So next, we're going to talk about 4 lending opportunities that we currently have. So I'm going to start with Walloon in North Ipswich. So looking at the deal characteristics, we've got land valued at 8.5 million. We've got a loan amount of 5.5 million. It's a first mortgage and an LVR of 65%. So we know where we are in the capital stack, and we're comfortable with the LVR. And investor returns is 10.5%. And what's the purpose of this loan? So it's to do 15 residential land lots of non-built form construction. So, Joe, could you tell us some of the highlights about Walloon?
Yeah, look, thank you, Xander. Look, tick, tick, tick. They've got all the planning approval, so there's no planning risk. Now let's look at construction risk. It's 15 residential land lots, so it's non-built form construction. They're 4,000 square metre blocks of land. So doable deal. And then if we look at the marketing risk, look, it's only 15 residential land lots. It's not as like it's going to flood the market. And we've all been reading the paper about the shortage of housing stock in Australia. So you're building something that the market wants. So I'm very, very comfortable about planning risk, construction risk, and marketing risk. Look, coincidentally, in the valuation report, they did mention this particular LGA, local government area. There's not many new housing estates coming on stream. So again, a shortage of stock. It's well located in proximity to amenity. So another big tick, and you're getting a 4,000 square metre block of land. So all the planning risk, construction risk, and marketing risk looks good. The investor return, 10.5% per annum paid quarterly. I think it's an excellent risk-adjusted return. And look, and you mentioned, you're in the best position in the capital stack at first mortgage, a fair bit of buffer with the LVR at 65%. They've prepaid a significant amount of the interest as well. So you've got really good, I think up to 9 months worth of prepaid interest at least. So look, I really like this opportunity. It's paying 10.5%, and I think it's open at the moment.
Yeah, it is. And you've been on site, walked the site.
Yes.
Also.
Yeah, we've walked the site. We met the borrower. The borrower is experienced in this particular style of development. So look, I really like it.
Yeah, lots to like there. So the next opportunity we're going to talk about is Tingalpa, Queensland. So some of our ongoing investors are already in this project, and we think it's a really good one. Looking at some of the land, the characteristics of the deal. So we've got land valued at 30.7 million. So it's getting up there, but we still think it's a doable deal. The loan's 20 million. So we think loans within 30 to 5 million are doable deals. So that's in there. A first mortgage and LVR of 65%. So again, we know we are in the capital stack, and we know what the LVR is. Investor returns of 10.5%. So yeah, similar to the last deal we were showing. A specialist property developer, and it's a latter stage construction. So, Joe, could you tell us something about Tingalpa?
Thank you, Xander. Look, again, a tick, tick, tick. This is, I think I'll go from the bottom back to the top. It's a latter stage construction project. So we're in day, month 9 or month 10 of this particular project. They built a program, and they built to budget. So they're building 19 industrial units. So all the planning approvals are obviously in place. The construction is tracking to budget. And I just want to talk about industrial developments. It's just what we call tilt slab construction. So they precast concrete on site, and then effectively they just tip it up to form out the units, and then they put some stainless steel roofing on to provide reinforcement. So it's simple construction. It's not difficult. We have our own construction manager who as a part of the loan condition, he attends all the site meetings. We're a party to the construction contract. But coming back to is it's only around about $2,000 a square metre to build these sheds. And we're expecting them to sell for between $5,500 to $6,000 a square metre, and they've achieved sales above that. So the sales have been really, really strong, and we've got 100% debt coverage. So the loan amount is more than covered. A very good quality counterparty. Coincidentally, on that the borrower has their own internal development manager who is highly competent and has been known to the lending team for over 20 years. So paying 10.5%, a latter stage construction project. I think there's only about 3 months to go on this one, but it's a good one to put a toe in the water. You're getting a really good risk-adjusted return, and your money will be repaid in about 3 months. And he's got another one in the pipeline.
Yeah, we've got a quick video to play about Tingalpa, and then we might talk a bit further about it.
Fantastic.
So we're here at Multi-Place Business Park, which is stage 5 of the business precinct here at Tingalpa. At this point in time, we're around 75% of the way through the program, and we've got the 4 major buildings up at roof stage. The structures are up. The sales on the project, we've covered effectively the construction debt. We have in the order of $28 million worth of pre-sales. So it's been a very successful sales campaign, and we currently only have 5 lots left in the complex to sell. We anticipate that by the time we've finished construction, all lots will be committed with sales. I think it's been a fantastic result. There's been a lot of demand for the product, and we've achieved greater than the sales rate that we expected when we commenced the project. It's been great working with Capital Property Funds. Found them very, very good to deal with, very professional, very flexible in terms of solving any problems that we've had on the project. It's been great to work with Rod because of his extensive construction knowledge. It's good to have someone on the project that fully understands the construction method and the program and knows what he's looking at in terms of projects and asks all the right questions. We're targeting to have the works completed by the end of the financial year.
Yeah, so really good video. I think my favorite bit of it is just seeing the project on day one, and now we're 10 months in. They're 75% complete. It's looking like a real crack. And as you saw on the screen, you saw Rod, he's part of the CPF team. He goes up there, ensures that everything's on track, and that's just another part of how we reduce risk, and we think it's a great risk-adjusted return.
Yeah, and look, that one's open at the moment. Again, it'll suit people looking for a shorter dated investment opportunity without harping on too much about a risk-adjusted return. But you're getting the 10.5%, and that was priced at day one when you had some construction risk and marketing risk. You're now at day 200 or thereabouts, and you've got very limited construction risk and very limited marketing risk, but you're still getting that 10.5% return. So I think that one's a very good one to keep an eye out for if you're looking for a shorter dated opportunity.
Yeah, that's finishing late August, early September. So yeah, there's still draws on that, and Tom, if you are interested in that deal. Moving on to another one that we've got at the moment, Paddington in Queensland. So looking at the land value, 42.5 million, loan amount of 27.6. So this is getting up to the top of our where we're feeling comfortable, but we still this isn't the first time we've lent to these people, and it's not the first part of this project, which we'll talk about later. So we're not too concerned about the loan amount being a bit higher than the other projects. We've got a first mortgage and LVR of 65%, so feeling very comfortable there. Investor return of 10%. So we'll go through some of the reasons that is 10% compared to the other two that were 10.5. Experienced property developer, and for this particular loan, which will be 6 months long, there's no construction. So Joe, could you tell us a bit more about Paddington?
Yeah, thank you, Xander. Look, this one, I talk a lot about this internally. It just seems to get better and better. So this time last year, they had approximately 1 acre of land in Paddington in Brisbane. For those of you that aren't familiar with Paddington in Brisbane, it's a highly affluent inner city suburb, tree-lined streets, lovely restaurants, cafes, boutiques, etc. High socioeconomic area, a nice view, very close to Suncorp Stadium. So very, very similar to Paddington in Sydney. You can walk down to watch the football, you can grab a meal, etc. So they had approximately 100 metres frontage to Given Terrace in Paddington, where they owned restaurants, cafes, boutiques. So they owned the buildings. Then they had about, almost an acre of land behind those shop fronts, which was an on-grade car park. That was this time last year. They had approval to build a 2-level subterranean commercial car park, and on top of that, a 2-level childcare centre, which has a 20-year lease to Kids Club. Now we fast forward to today. You've got all those cafes, restaurants, and boutiques providing income support to the loan, and then you've also got the commercial car park and the childcare centre providing additional income support to the loan. So they've increased the income profile of the underlying asset. They've enhanced the value of that asset. They're built to program and they're built to budget. They've been excellent counterparties, and they've now got planning approval to build 12 high-end residential apartments on the site, which will have northerly views over the city and back towards Suncorp Stadium. And when the valuer was chatting with them about commencing a valuation report, he said, look, see if you can get 2 pre-sales. Without even trying, they achieved 3 pre-sales at $4 million per unit, which means they've got a gross realisable value on those residential apartments of between $50 to $60 million. So it looks really, really strong. So this is the next chapter in Paddington. So at the moment, they've got the development approval. They've got the income support from the childcare centre, the income support from the commercial car park, the income support from all the restaurants and boutiques. I think it equates to around about $2 million per annum in income support. They've prepaid all the interest for the 6-month term of the loan. And they're now just waiting for we call it in Sydney a construction certificate. I think they call it a works approval in Brisbane. So they'll firm up their quotes with their builder, polish off some of the rough edges of their design, and get their works approval over the next 6 months. And then once that has been achieved, we will offer them a construction finance facility.
No, there's a lot to like there. I think the important bits with this loan is prepaid interest. So for the full 6 months, they've got the prepaid interest, and there's going to be no construction with this loan at this stage. So for the next 5-6 months, as you said, they're firming up their quotes, getting their works approval, and then they've got the income support from the childcare centre that they've built and the underground car park. So there's lots like that. And again, paying 10%. The other two were paying 10.5%, but this has the income support. This has the fully prepaid interest. This has no construction. There's a lot to like here. And we're looking forward to 6 months coming and them building the next journey of Paddington, which will be really exciting. And really.
Well, the other thing too, which you reminded me, is that about this one, which I like, there's a lot to like, is that you've got 1 acre of land, which in Paddington, in that is contiguous or joined together. Is that it has taken the landowner a generation to acquire that underlying land. So not that you want them to go into default, but you have to ask yourself the question, would you be happy to own the underlying land if this borrower did go into default? And the answer is absolutely yes. It's a unique, irreplicable piece of real estate.
So we're just going to have a look at all the lending opportunities next to each other. We didn't talk about Spring Creek Stage 6, but that's a really good deal. That's Stage 6. We've funded all the previous stages. So Stage 6 of about 1,000 lot estate. They've had 300 pre-sales. Oh, sorry, not 300 pre-sales. 300 sales to date. They're continuing. They actually don't have enough land lots there to meet with demand. So that's another great one. If you are looking to get started, Terry McKinnon, we've lent to him many a time before,
yeah.
and always delivered. So that's a really good one that we really like. And on that risk adjusted return, looks incredibly good at 10%.
Yeah, and what we can see, look, thank you for that, Zen. I mean, just to add to the Spring Creek one, it would suit investors that have never really dealt with this before. You've got non-built form construction, just a land subdivision, a highly experienced developer, been known to us for over 15 years, and he's achieved, stage 1 built and sold down, stage 2 built and sold down, stage 3, so on and so forth. Now it's stage 6, so you're getting pretty good comfort around this guy's ability to deliver and sell down. So it's a good one to put a toe in the water. 10%. Nothing that we offer at the moment is less than 10%. Where we, at the moment, I think cash rates have moved, 50 basis points since a lot of these loans were priced. Probably some of the really good ones, like probably Spring Creek stage 6, I would have thought this time next year it might have a 9 in front of it. But some of the others, I think we're going to try and hang on to that 10% return. And we are also offering second mortgages between 16 to 18%. And we also will be bringing out opportunities for our investors to sit alongside the developer and take a higher rate of return, but sitting higher up in the capital stack at that 25 to 27% per annum return.
Yeah. So yeah, a lot to look forward to. Again, these are 4 deals we've got at the moment. We've got a pretty full pipeline at the moment. So if you miss out on these, and again with Tingalpa, it's got 4 months left. He's moving into the next one, which we'll hopefully be offering to the market soon. And that's a really good one that we're really excited to look forward to.
Yeah, well, just on that one too. I mean, his name is Mark Drillich. He has built Tingalpa to budget and in accordance with the program and sold it down above expectations. What Mark does is that he provides a higher end industrial development. So he's a very experienced concreter, and he can construct really, really well. He has a little bit of architectural flair to his product. So there's a little bit more glass, a little bit more powder coating, etc. So just make it a little bit more mature landscaping, which you don't often see in industrial parks. He's trying to differentiate himself. And he's now secured another site. So you would be able to come into Tingalpa, get to know Mark, and then you can roll into the next opportunity, which will be coming in the coming weeks or months.
Perfect. Now, we'll move on to the question and answer part of the presentation. So if anyone does have any questions, feel free to put them in the Q&A. It should be at the top of your screen. And we're happy to take any questions. If there are none, you can always call us or send an email to us. And we're more than happy to answer any questions you did have. If it's come to you after we've left, or you've woken up tomorrow morning and you've gone, oh, this was on my mind, feel free to send us an email or give us a call. Or
if you like a copy of the presentation.
Yeah, and this recording will be available to everyone afterwards. So if you did want to rewatch a specific bit, it'll be made available to everyone.
And look, finally, I'd also like to add too, thank you for your time for participating in our webinar. You can contact our office, and if you haven't set up an account with us, it's a quick and easy process. You can scan a QR code or just ring our number 02 8004 6218 or email, and we can help you get an account established, whether you've got a self-managed super fund, family trust, investment company, etc. We set up all different entities, so we'd look forward to having a chat with you if you are interested to set up an account.
Well, at this stage, we don't have any questions. So we might thank you for your time tonight. I hope everyone's going to watch State of Origin. Go New South Wales, and feel free to reach us tomorrow or whenever you've got a question. So thank you for your time tonight.